Hi, folks. Please read the disclaimer. Very nice, interesting video today. We're going to talk about the real reason your stock picks aren't working anymore. Um, so, where it all began, the foundation of modern investing began in 1934 with Benjamin Graham. He published the security analysis thesis, and it focused on buying undervalued stocks, focusing on intrinsic value. There should be margin of safety, and you should all be doing long term holding. And then, the Graham philosophy was taken further by Warren Buffett, who was Graham's student, and he built 50 years of outperformance on buying great companies and holding forever. Peter Lynch then came around in the 1970s to 1990. He did 29% annualized returns, and he said, "Buy what you know and know what you buy." So a lot of frameworks came around, whether they were, uh, coffee can investing, or so many other kinds of investing that were there. And a lot of fund managers worked with different types of investing thesis, and most of them worked very well in their durations at which they were applied, which was extending over years and decades. But what continued to happen was that change was a constant, and every time a thesis would be really successful, things were actually gradually changing. So what we need to question at all times is that the thesis that we are applying to our investing, is it valid today or not? Is it sufficient today or not? Yes, it has worked in the past, but is it sufficient today or not? Has the market evolved beyond the framework that we are using? And perhaps our framework hasn't evolved along with it. So, for instance, I'll walk you through some instances where people are using certain frameworks which may or may not be so applicable right now. The most common one is using price earnings ratio, or ROE, ROCE. And these days, companies there are companies that don't own assets, and they don't make continuous profits for years, and they pivot overnight from one business to the other. So can ROE, ROCE, PE still tell the full story? When companies today are more platform based, they're asset light, they're driven by networks or data moats rather than asset moats. So do traditional metrics still measure the right things or not? And if there are companies where leadership rotates, or this buy and hold forever gets disrupted by technology disruption or some other disruption in the marketplace, uh, how do you sort of look at the company? So what you miss by following these traditional principles alone is where we want to discuss uh, today's video around, and let's break down into real examples. So these may be selected examples which highlight this. The thesis that I'm trying to make out necessarily need not be true with every case, but certainly true in these cases. And Zomato, for instance, it had years of losses, negative return on equity, high cash burn, median price earnings of 404. And then they did the Blinkit acquisition, so there were more losses that were coming around. And stock, of course, from 2022 went up like 400% at 70% CAGR in just 3 years. So if we were traditionally looking at earnings or return on investments, uh, the return on equity, the Zomato would probably never look undervalued. In fact, the guru of value investing, Mr. Ashwath Damodharan, he said that the worth of Zomato is like 35 rupees. And look where Zomato has gone post that. Another example could be Ether Energy. Again, no profitability, over 2,700 crores in losses in the last 3 financial years. Very high investments, very high capex, negative EBITDA. Uh, Traditional filters, if one were to apply to such companies, you will get the answer, please avoid. It's too expensive, no earnings visibility, and it is trying to compete with legacy players. So there is, really no chance. Yet Look at the price outcome. The stock has gone from May of 2025 till now about 125% in just 7 months. Another global example could be Tesla itself. It has had negative profit for years together, P/E ratio swinging from negative to positive and going up to even 1300. I mean, absurd figures like that. No traditional valuation consistency is there. Yet price has compounded from pre-COVID levels up 1900% in just 2 years, which basically is just simply mind-boggling. Nothing can really explain that. Own homegrown company Adani, also very high debt, very high earnings volatility. Much later, short seller allegations of fraud by Hindenburg, which were never proven right. Continuous government issue highlighted by media analysts, opposition parties, governance issue, sorry. Uh, but traditional investing was avoiding this stock due to the governance issues, and the price actually was running up. So from not just now, but from 2014, 15, 16, from 2017 onwards, from 33 rupees, the stock went to 3,000 rupees. 50% CAGR for almost 10 years before it flattened out a bit post that. So, what are these examples showing us? That some of the biggest winners of the past many years had no profits. They had extremely high price equity ratios. They had weak fundamentals, if you can classify or qualify that in some ways. Some had governance issues or concerns at least. So, despite that, the price was not bothered and the price was telling you a story. But because of these narratives, some people were not willing to believe in that story. So traditional metrics failed to capture the stories. Ultimately, why are we in the markets? We are in the markets to make sure that our investments generate decent returns. We are not in the market to prove that a company has 100% fantastic governance or it has 80% great governance. We are not in the market to prove that we have bought a stock at low valuations and we're going to sell at high valuations. We could also buy at high valuations and sell at higher valuations. So price, earnings, ROE, basically these are all rear view mirror driving tools. The price is moving on expectation, not on the past number. So if we say get a quarterly result of a company, that's, let's say, uh, October to December quarter. The result will reach you by, let's say, January third week. So in January third week, you are being told what has been the outcome of the business that the company did in October, November, and December. You think the market, which is a a sort of a supreme equilibrium of all kinds of information out there, is waiting for this 4 months to go by and then move basis that? Or do you think the market already knows through various channels? Let's say a company did really great in October. The sales channel is moving, the vendors are moving, the suppliers know what is happening, what kind of growth is coming. Even the person who's printing vouchers for that company knows that this month there is more demand. So all that information is actually percolating through the system in various formats. I'm not even talking about insider trading and all those things. That of course also happens rampantly. You think a sales manager in a company will not go tell his friend that, see, I got an increment this month because we had 100% additional sales. So while the company has not come out with that information to the investors, significant part of the interested world already knows about it. So on the day of the announcement of the earnings, yes, it is a screenshot that is being presented to you for the past 3 months, which is also delayed by 3 weeks. The price is moving on expectations. The price is saying, okay, that is done, I know that. But now, what is the commentary about the future? Is there anything to look for that? So, the market rewards the future optionality more than current or past numbers. those are already baked in. So the narrative plus liquidity plus institutional flows, they dominate, the markets versus valuation signals. Now liquidity is something which is like, without that nothing moves. If anything is moving up, it is because liquidity is moving into that asset. If something is moving down, it is because liquidity is going out of that asset. It is as simple as that. So liquidity is like water, it will flow where it needs to flow. So ETF inflows if they are coming, FII inflows if they are coming, DIIs are buying, liquidity is driving things up, and similarly the other way around. Then there is, you know the concept of narratives driving stocks. So there could be a lot of narratives around particular industries, around EVs, AI, platform businesses, digital India. Any companies which are associated with that kind of narrative will get that push, and liquidity will flow towards that. So all this basically feeds itself. So, some narrative, some that will pull in through some liquidity, that will get more momentum as you go around. There'll be stronger price, more buyers, at least momentum buyers will get interested. And there is also the uh, early mover advantages, so early leaders in new categories. So somebody creates a new category, some company creates new leaders within that category, so that scarcity premium can also be there sometimes, which is nowhere captured in traditional metrics. And then of course there is risk appetite about whether risk on trade is happening, risk off trade is happening, global liquidity. If dollar index goes up, money flows to the US, it goes out of emerging markets. No valuation metrics can tell you that. It is all about flows, and the flows are created because of narrative, and narrative is created because of some action on ground which is not yet perhaps in front of us. So the BBC principle that we normally talk about, which is Bhao Bhagwan Che, which literally translates into price is God, essentially means that the market usually prices in all the information that is available about that stock, uh, that even may not be public information. So what we may feel today is an expensive stock is trying to price in something which perhaps we don't know yet. And it could be wrong also. It's not that if it is getting priced today, it has to be right. The price is true for today's moment. The next moment, it could have a different price, and that could be the truth in the next price, in the next moment. So you have to see how the price is basically leading indicator. It is not looking at the results of the past 3 months. It is actually pricing in what is the market looking forward to in this stock or index or whatever it may be. So when price runs like that, it will include expensive stocks also, which are traditional metrics expensive, but which can keep getting more and more expensive. They will include the stocks that and this is sort of the new modern framework, you can say, which will allow participation in early leaders. So stocks that are promising are leading despite having no earnings. uh, One that does not rely on opinion or comfort. So your top 20 stocks give you a lot of comfort that they have this metric, that metric, traditional metrics are all satisfied, but they're not moving like the new stocks are moving. And a framework that basically removes any bias from the process. So you need to have a framework which basically unshackles you from such metrics which hold you back. Of course you need to have your risk management also in place, because what narrative or liquidity is driving today may or may not last, just like any other stock. So those uh, risk management tools will need to be there, but it's just that things are evolving and changing all the time. So another example could be, like, if you have been in the market for some time, 20 years back, a stock that used to have a price earnings of more than 15 times, for instance, used to be considered to be very expensive, that we'll buy only at 10 or lower. If it is 15 or 20 and above, it's crazy high. That crazy high of 20 is now at 70 or 80, and stocks are not even coming to 20 to make you buy. Very few stocks are even available at 20 times earnings. So if you get stuck with the traditional metrics, you are unable to get into stocks at all while they continue to run. So that's exactly the issue that is there, that because the global uh, money base has changed. If the entire world had X amount of money 20 years back, it has 10x of that money today. So if the base money has gone up many folds, obviously all assets have also gone up many folds. So you can do relative valuation of one to the other, but absolute valuation perhaps is not making sense. What if the Fed tomorrow comes and says we will keep printing several trillion per year and the debt will continue to rise? What will happen in that case? All the 30, 40, 50 Ps in the companies will suddenly go to 70, 80, and it will stay there. So this absolute valuation that we have always relied on in the past, because money was sound money and money supply was reasonably controlled, that has gone through the roof, and that basically has caused all this problem of not being able to use traditional metrics for these analysis. So price, according to us, is the primary signal. It is basically telling you where the flows are going, whether they are coming in or they are going out. Uh, the rules for entry and exits are basis, price, volume, etc. Parameters, and there is no personal bias. I mean, I have no personal liking for any stock, and I have no personal dislike for any stock. Of course, the exclusions basis, some red flags in the company which the regulator may have, are always there. But this is primarily the thought process in a unbiased and non-discretionary way of investing. So let us know in the comments how you like this content, and how you deal with stocks which are showing very high earnings ratios, price earnings ratio, and have you ever regretted avoiding a stock because it had a high PE and then it kept running up and you could not buy it? Do let us know in the comments. Do join the Weekend Investing Community. There's a form in the description. If you drop your email there, we will connect with you and start sending you some premium market insights. Do like and share these videos. If you like the content, you can watch some other content on your screen right now. And always do remember to subscribe to the channel. Thank you. Bye.